Yeah, it doesn't look good, and folks may look at a high yield index, let's say HYG, and they see it's down 10% year to date, and they say, oh my God, look at the credit markets, they're imploding. But actually, the bulk of that sell-off has been due to a rise in risk-free interest rates, which is the Fed, and not a widening of credit spreads. But what your chart here shows is that the widening in credit spreads is coming. Joseph, your thoughts on two things. Number one, do you think the widening in credit spreads is coming? And also, can you just explain from the point of view from the Fed, how do they think about term premium? Do they want term premium to go up now? Do they want it to go down, and why?
Oh, so Jack, just on your last point about HYG, there's actually an interest rate hedged version of HYG that hedges out that interest rate, so you can more clearly see whether or not it's because the credit spreads are widening or if it's because of interest rates.
Yep.
Yeah, I don't have it with me,
HYGH.
but
Yeah.
HYGH, yeah. So that would be able to show your point very well. So I think the Fed will definitely cares about term premium, and they want it to go wider, and that's what QT is all about. So again, if you think about QE as trying to compress term premiums so that everyone will, shift their portfolios into other assets or take out loans to buy houses and things like that, well, QT is the opposite. And how does the Fed think that it can expand term premia? It's by letting the market digest more treasuries. So that's what they're going to try to do over the next few months. So it's QT for treasuries is always a bit strange. I mean, for agency MBS, for example, once QT was coming, the market was aware of it. You can see the spread between agencies and 10 years widen pretty significantly. For treasuries, it hasn't been that much. So I'm not really sure if the market is slow or what else is happening. But over the coming months, there's going to be a lot more treasuries coming onto the market. So I would think that, to me, that makes sense that we'd see term premium widen a bit going forward. And I'm not sure how credit spreads will be going forward. Michael's charts were very, very compelling. So it makes sense to me that they would widen as well.
Yes, well, history is definitely on the side. I mean, the charts show that clearly. If it were not to happen, it would be a departure from history. Michael, you've got a few more fantastic charts I want to go through. Let me see if I can find it. Oh, it's about good liquidity and bad liquidity, and it's got a sort of a table. And I want you and Joseph to explain what's going on here. So, what's good liquidity? What's bad liquidity? And why does it result in changes in FX markets, currencies, as well as yield curve? And where are we now? What have we seen?
Okay, well, the basic idea about this is how our methodology operates, and what we think of is in terms of both the quantity of liquidity and the quality mix of liquidity. Now, the reason for looking at this is what drives both the forex markets and the fixed income markets, where we take the yield curve as probably the best measure of the fixed income markets. Effectively, the yield curve is summarizing both rate expectations and term premium. Now, what that basically is saying is that good liquidity is liquidity that the private sector is creating. It's good from the perspective of how the market, and particularly the forex market, views that. So if you have private sector liquidity, let me give you examples of that. So for example, if you get corporations creating lots of cash, or households managing to produce lots of savings, that cash generation is probably coming from a vibrant economy, and a vibrant economy will cause the currency to strengthen, right? But if the Federal Reserve starts printing money, expanding its balance sheet, that's bad liquidity from a forex point of view, and the currency will weaken. So what you want to look at from a currency perspective is to subtract Fed liquidity from private sector liquidity creation. And that tells you about how the forex markets are moving. Now, the traditional academic view is not to make that distinction. And what academics do is to lump all that money or liquidity together and start to look at liquidity for the US versus liquidity for Canada or Mexico or Japan or whatever. That's not the right way of doing it. If you do it this way, you get much, much more accurate projections of currencies. So what we're doing is looking at this quality mix and then taking that relative. Now, the other dimension is then to look at what drives the fixed income markets, and that's the sum of liquidity. So in other words, it's the pure quantity and not the quality. So if the private sector creates liquidity, it's creating lots of cash. The Federal Reserve creates that cash. Domestically, investors are not too bothered about where it comes from. And if there's lots of liquidity, they can just use that liquidity and they go out down the risk curve, shun government bonds, and go into stocks or crypto or commodities or credit. Make sense?
I think that's a
Yes.
really good distinction between private and public. I mean, if you're private liquidity, you're created by a bank, right? So a bank makes a loan to someone who's going to be able to pay them back. So likely it's, let's say, to an investment that actually has a chance of being successful and paying the bank back. So it's well allocated, so to speak. But central bank liquidity, ultimately, that's providing money for the government to spend, and they just kind of give that away to their friends and stuff like special interests or whatnot. So they don't care if it's well allocated or not, which is the key difference. So I think that's a really good distinction.
Michael, why is the People's Bank of China not stimulating, given that their economy is close to / in recession? You said it was because they wanted to protect the value of the yuan. Why is that a strategic priority if China has so many trillions and trillions of dollar reserves, treasuries? Historically, I don't think of a yen depreciation as something that China has been worried about.
I think that if you look at the evolution of capitalism, what you tend to find is that as capital becomes mature, it wants to export itself. It wants to go international, and you need purchasing power to do that. And effectively, a strong currency gives you that purchasing power. Now, the Chinese basically want the yuan to be used as a vehicle currency and as a savings currency, and a strong yuan will basically enhance that situation. Or let me put it more, or maybe in a more anodyne way, they want a stable currency, at least a stable currency. Stability is what the Chinese really look for. Now, I go through this in the book Capital Wars, but basically I start with a quote from a general from the People's Liberation Army that says the goal of the Chinese authorities is to challenge the dollar. Okay, they want to get rid of the dollar, particularly within Asia. And the route to do that is basically three paths, in my estimation. It's number one is redenominating Chinese trade in yuan and developing a trade credit system among Chinese banks. Why is that important? Because that's how the dollar got onto the map after World War One. Exactly the same formula. Basically, the dollar kicked out sterling within a very, very short space of time, because more and more trade after World War One was in dollars, and US banks were allowed to come in by the Fed to transact that. Okay. Number two is they open up their bond markets to foreign money. They're not interested in what the equity market's doing. They're interested in what the bond market's doing. And that's the key thing. And they've already sucked in a lot of money into Chinese government bonds. And that's important. The third thing is to create a digital currency that will allow peer-to-peer transfers. They are anyone can estimate 5 years ahead of America on doing that, but they're basically doing it. And so what you've got is you've got the ability of the Chinese now to increasingly challenge the US dollar within Asia. And they're beginning to do more and more trade denominated in yuan. Now, the critical question that people that don't believe this have got to ask is, why is China setting up so many swap lines, yuan swap lines, around the Asian region? The only conceivable reason is that those swap lines are there for yuan-denominated trade, ultimately.
So basically, they're preparing a Euro RMB.
Yeah, I think that's the thing. Now, the way to stop that is to start shaking the tree vigorously, in my view, and to basically put pressure on the yuan. And that may be being done, as I said, and it may be a pie-in-the-sky view, by the yen as a Trojan horse, because it starts to break that stability. And it puts a lot of pressure on China, given the integration of the Japanese economy with China. Look at the won, Korean won. That's also devalued recently, in line with what the yen has been doing. So a lot of pressure is being heaped on the yuan, and it's weakening, but the Chinese are trying to hold that back. So if you look at the interventions, in other words, the money market movements, let's say, in China over the last 10 to 12 weeks, they've been absolutely in line with strength or weakness in the yuan.
Wow. And that long-term geopolitical macro realpolitik objective is going to take number one priority over the strength of the Chinese economy, the health of Chinese real estate and stock market and credit markets. That is number one.
Until it doesn't. And that's the point. And the bigger the pressure, Winston Churchill once said, "You kick somebody when they're down. That's the best time." So after the COVID crisis, China's economy is reeling. Then it's had another blow. And I would just say to people, go read Janet Yellen's speech, the friendshoring speech to the Atlantic Council. That, I think, makes the point very clearly about how the world is going to work in the future. Are you a friend? Are you a foe?
Oh, yes. Michael, people have been telling me for probably almost 9 months now that the Chinese credit impulse is going to bottom. Has it done so already, or are we still not there yet?
No way. I mean, as long as I've been looking at China, which is, 15 years or so now, looking at it intensively, people have been saying it's around the corner. The Chinese are going to ease, they're going to ease, they're going to ease, they're going to ease. Never happens, really. I mean, okay, they did after the GFC in size, but generally they haven't done it. Particularly since 2016, there's been very little stimulus. Just look at the central bank balance sheet, the PBOC central bank balance sheet. It's flatlined since 2016. That's not a central bank that's doing lots of QE. They want stability. The goal of China has changed from growth at all costs to stability. And the stability was all about stability of the yuan to try and develop the yuan as an international rival to the dollar. Well, good luck on that one.
Joseph, I want to start with you. Is there any glimmer of hope for risk assets, credit, crypto, SPACs, non-profitable technology stocks? What is there any scenario you can imagine in which 9 months from now those will have done okay, if not well? Or is it just, investing in those stocks and those types of things at all is fighting the Fed, and you don't want to fight the Fed?
Well, honestly, the best scenario for risk assets 9 months out is for us to crash right now, so we restart up the QE cycle, and then we can have risk assets go higher. Absent that, I'm with Michael here. It seems like things are going to be pretty turbulent for a while.
Yeah, I agree. I mean, I think take a long summer break, and get back and start thinking about the markets again, probably for the early part of 2023. But I really think it might be second quarter before the markets or the risk markets really take off again. But they will, and there's a fantastic opportunity there. Make no mistake, there is. But it's not tomorrow.
And so, Joseph, is cash something that you think will have a lot of value if everything's going down?
Oh, if you could short, I think it sell some, let's say, tech stocks or something like that. But cash is good too. What I've noticed over the past few months is even though everything is selling off, energy is still going higher. Energy seems to be very, very bullish. So, I mean, I think you could hide there as well. Seems a lot of those companies, they pay pretty good dividends. So, it'd be better than cash because you would be potentially having some capital appreciation and receiving some cash flow.
And I listened with great interest to an awesome podcast you did with George Noble a couple of weeks ago. I mean, his view is exactly the same, and this is a trader's instinct. I mean, George is a doyen of international in the US. He was at Fidelity overseas, began in the late 80s, and he knows a lot about international. And his view instinctively is absolutely the same as this. And I think he's nailed this market completely. The problem with shorting in a bear market is you get very vicious rallies. And that's the issue. I mean, I think actually it was George Noble who said to me that if you look at NASDAQ basically collapsed in the Y2K bubble when that burst by something like 85% or whatever it was. But you saw 10 rallies of more than 25% a day. Just think of that one. If you're short, that would certainly give you a lot of pain.
Guys, it's been fantastic having you on Forward Guidance. Thank you so much. People should definitely follow your work. Joseph, people can follow your writings at fedguy.com. Your Twitter handle is @fedguy12. Michael, where can folks find you if they want to experience your research, see your charts?
You can take a look on Twitter @crossbordercap, I should say, the Twitter handle.